Good morning, everyone. Welcome to the David Eccles School of Business. We are so excited to have you all here. I'm your host, Riley Smith, and I'm the Alumni and Annual Giving Specialist here at the Eccles School. Recently, our dean, Rachel Hayes, said of the Eccles School, quote, "We teach our students to be doers. We challenge all of them to launch a product or company or join one. Then we give them the information and resources to do it," close quote. Essentially, we are the premier higher educational institution for entrepreneurship. And so we are so grateful to you, our in-person and our streaming audience, for joining us today for our Eccles Alumni Forum. As a quick reminder, lunch will be available for pickup just as you exit the auditorium at the end of the event. I'd also like to thank today's sponsor, Mr. Mike Hale of Balance Money. Please join me in thanking Mike for sponsoring today's forum. Mike is not only our sponsor, but our moderator today. Mike is a 4-time graduate of the Eccles School. He is the co-founder and COO of Balance Money and has a wealth of knowledge regarding startup funding. And then to introduce our panelists, our first panelist is Karey Barker. She is the managing director of Cross Creek and has developed the concept for Cross Creek while working as a portfolio manager at Wasatch Advisors, where she spent over 15 years managing small cap growth stocks. Over time, she saw a need to develop expertise in venture capital to better understand emerging themes and competition. In 2006, she founded Cross Creek within Wasatch to address that need and went on to lead the Cross Creek team through its transition to an independent firm in 2012. Please welcome Karey Barker. Our next panelist is Ryan Sanders, who is the managing partner of Mercato Partners. Mercato is a platform designed to find, fund, and support compelling entrepreneurship. With more than 1.6 billion in AUM, Mercato has assembled distinct investment practices in early stage, direct secondary growth, food and beverage buyout, and SPAC. Traverse is now operating out of its 4th growth fund and targets high growth companies in underdeserved and undercapitalized geographies. Please welcome Ryan Sanders. Next, we have Sid Krommenhoek, who is the founder and general partner at Album VC, an early-stage venture capital firm focused on software startups. Album has made investments in more than 70 startups, many in Utah, including Degreed, Divvy, MX, Podium, and Weave. Prior to VC, Sid started 4 startups, including Zinch.com, an online portal connecting students with higher education. Later, he led Zinch's growth in China, moving his family to Beijing and launching Zinch.cn, one of the first foreign online brands to reach scale in China. When Zinch was acquired by Chegg Inc. in 2011, Sid led Chegg's international efforts through initial public offering in 2013. Please welcome Sid Krommenhoek. Next, we have Kat Kennedy, who is general partner of Kickstart. Before joining Kickstart, Kat was president and CXO of Degreed, a company dedicated to changing how people develop skills, build expertise, and grow their careers. Kat's 15 years of operating experience give her a unique perspective as an investor, one that allows her to not only spot talented entrepreneurs from all backgrounds, but also to serve as a mentor, fostering innovation through every stage of the company's growth. Please welcome Kat Kennedy. And finally, we have Shawn Olsen, who is the managing partner at S20 Capital. Shawn is the managing partner who sources and leads investments in DigitalOcean, or DOCN, Grub Market, my apologies, and Bloomreach. He sourced and co-led investments in Entrada, Single Store, Upgrade, Chipper Cash, and Kin Insurance. Shawn received his Bachelor of Science in Finance from the University of Utah and his JD from the S.J. Quinney College of Law at the University of Utah. Please welcome our business school alum, Shawn Olsen. All right, and again, thank you all so much for coming today. We will have a brief Q&A session within the panel, so be thinking of questions you may want to ask. Finally, so Mike, every person on this panel represents a firm that focuses on a different stage of capital financing. Can you tell us more about these different stages?
Yeah, thanks, Riley. So we'll start with CAT. CAT represents Kickstart. They are pre-seed and seed financing, which is the earliest stages for venture capital. Sid with the Album, they represent seed and Series A, which is still considered early stage for venture capital. Ryan with Mercato is growth stage fund, so they're post Series B. And then Karey here, she is actually representing Cross Creek, and they invest just prior to an IPO, which is the latest stage that venture capital normally gets involved. And then Shawn at the very end, he actually works in the secondary equity markets, which is really interesting. And to define that for the audience, a secondary equity market or secondary market is investing in a company by buying equity that goes to a party or individual rather than money on a balance sheet. So now that you guys have some context to the panel makeup and what each individual represents, I want to jump into the first question. So Sid, when we were speaking, you had mentioned that universities are the ingredients of innovation. How do you see the U and BYU adding to the entrepreneurial ecosystem in Utah, and how do we compare to other notable entrepreneurial ecosystems?
Yeah, good question. So there's a great piece written by Paul Graham where he talks about kind of the identity of different geographies. If you think of Paris, if you think of New York City, like there's distinct identities that these cities or metropolitan areas have. As it relates to the startup ecosystem, you have, of sort of most note, Silicon Valley, and when you start to break down the pieces of Silicon Valley, there's Research One institutions, there's sources of capital, there's a young culture that oftentimes is around those universities, Stanford, Berkeley, where these ideas are happening. Utah has a lot of that, right? We have the youngest population in the US. We have great Research One institutions from the U to BYU and a lot of other great schools. UVU has the largest population of students, and all these universities are kicking out, as it relates to software companies, engineers. And so when you think about the most salient kind of point for startups from the early stage where a few of us invest, it's these collisions that happen oftentimes in university settings. If I look back at my startups, they were the people that I was going to school with and the time we had in between classes when we could start to ideate and think about what we might be building, and then have the people that we could rally, and with time, the sources of capital and the engineers that we could hire.
I agree with you completely. Ryan, do you have anything to add to that?
Is it on? Maybe two comments to start. I knew that I was going to be seated somewhere by Sid and Kat, and I wasn't going to be outshooed today. So today, typically these are Bulls red, but today they're U red. Even as a BYU graduate up here, this was for you. The second piece is, I would say, as I sit here and look, I'm more confident in the ecosystem around here with what I see here on stage. It's a good day to be an entrepreneur. When I was an entrepreneur at BYU and thought about what I'd want to be and grow up, we were missing some of these ingredients, and I'm sure we'll talk about more of that today. But when we spend all of our time in what we think of as capital underserved market, undercapitalized, undersourced, sometimes underappreciated. So for us, Silicon Valley, New York, and Boston are great examples, but they're places that we don't spend time. We like the personalities that sit in places like Salt Lake City and Boise and Portland and Chicago. And we actually develop an algorithm, and it tells us where we think that there are more likely to be growth stage deals over time, and some of the factors that go into it. And I think these are some of the factors that have improved here over the last 20 years, because this is a rising center of entrepreneurship. I think Utah's almost tipped itself into a tier 1.5, maybe tier 1 in certain areas, maybe tier 2. But one of them that Sid touched on is the STEM-based talent. And if you take the corridor from here, down to BYU and UVU, there is a top 5 in the nation graduate pool of STEM-based talent. It's not very far off some of the hubs, certainly around Stanford, MIT, Harvard. Raw talent is available to build companies, I would say here today. Second thing that we look for are strong, sort of centers that have Fortune 500 companies. And today we're just walking forward with a couple of those types of companies. That's a piece that maybe has lagged for us. We haven't had as many really large, sort of sustained IPOs and sustained public companies. We have some of those, here today. Third for us, we look at are the number of business starts per capita. And there's some really interesting trends that have been accelerated in just the last 2 years if you look at what COVID has caused. So if you lived in San Fran, New York, or Boston and you left because of health or finance or political, whatever your concern was, and you came to Salt Lake City and you thought you were going to enjoy it because of the outdoors, because of the things, I don't think you're going back. So this is a place that I believe will have more committed entrepreneurs, and they do so here because the costs of input are less. Our rent is half. Our people are, sort of a third to half off of some of those capital concentrated cities. So when I look around, and I guess sort of your question is, sort of why right here? I think it does start with universities. If I thought about that very first ingredient that I delivered, it was what you'll do right here is what causes the raw ingredients of growth businesses. And in fact, there's no better time as an undergraduate or a grad with perhaps less responsibility, in life to go start a business and to be an entrepreneur. So bullish on what's happening here.
Yeah, that's awesome, Ryan. I appreciate your insight. And being an early stage entrepreneur myself, I've got to tell you, there's programs like the MBC accelerators that are just so powerful here in Utah. We have people like Landon Ainge who provide, a bunch of angels to get together in a syndicate and provide capital prior to venture capital. It really is magical. And actually, it reminds me of when you were talking, Kat, you had mentioned that it's such a magical time. I think Ryan did a good job talking about it, but do you want to add anything to how special this time is right now here in Utah and in the nation?
Yeah, happy to. And who won the shoe game is the real question. We can do a vote.
I didn't know it was an outright competition.
Well,
I didn't bring my heat.
Everything is. Everything's a competition. So why is it a special time? If you read Tech Buzz or the Silicon Slopes newsletter or any just like geek out over the news wires, you'll note that a lot of the venture capital funds have recently raised new funds. There's capital to be deployed right now. And that is an exciting moment anytime, but I believe it to be very exciting right now because we're looking to deploy that into very tight, capital efficient, high growth types of companies. In a frothy market, you can get by with a great idea and a team to chase it. In a market like we're in today, you really need to know your business. You need to have things in order, and that's how it should always be. So starting a company now, doing it in a disciplined way with lots of capital out there to be deployed, I think are the right ingredients to create some incredible companies down the line. Yeah, that's why I think it's exciting. Just lots of money out there for you all to go and get.
Yeah, that's definitely nice, right? One thing that you'd mentioned when we talked about was a founder opportunity fit. And there's, I'm sure, students in the audience looking to, solve a problem. I'm wondering if you could talk a little bit about that, and is also founder resilience and how you identify that as a general partner at Kickstart.
Yeah. So founder opportunity fit, what led to us discussing that was just like, what do we look for, especially in the early stages? Often we can be the first money into a company. Sometimes it's just an idea. There's no product. There's no revenue, right? So in lack of those things and lack of traction and dollars to prove out a business, what are we looking for? And for myself, I've got a scorecard that's all around the founder initially, and then the business secondary. And the types of things that I'm looking for in a founder, as stated, are they're resilient. Going on a venture-backed path is no small feat. It's no small feat to start any business, but in venture, you are signing up for high growth. You're taking on capital to take big bets and grow faster and attack the opportunity faster. So the pressure is definitely on, and you have signed an agreement to take on that pressure. So it's not always going to be fun. It will be joyful, But being able to find the joy and push through the difficult moments and always be on offense is something that I hope for in the founders that I back. And I do believe that resilience is key to being able to sustain all of those moments. And how do you identify resilience? That's really, really tough. It's talking to people that they know. It's asking them about difficult things that they have gone through before. It's also sometimes I play a little mind game in the initial pitch just to see what they do and how they react to me, right? It's different per founder how it's identified, but being able to show off that you can do hard things and that you know the journey that you're signing up for, I believe is critical at all points as you're fundraising, but especially in the early stages. And there was another, founder opportunity fit is the secondary one. So why are you the person to build this business? Not only proving that you believe it can be high growth and large scale, but you're the person to take it there. You see an opportunity either in an existing market or a category that you're going to create that no one else does. The combination of you and your business is something special. That is definitely something that we look for, and being able to speak to that and go into a fundraising process with that confidence that you're the person to build this business always puts you on the right foot as you're going out asking for capital.
Thanks, Kat. Yeah, and Sid, when we were speaking, you had mentioned that you actually like to go see founders at trade shows. You even place investments in like the 7 most recent unicorns in Utah. So can you add a little bit to that and tell me kind of your unique perspective of picking founder opportunity fit?
Yeah, we found in the early days, like spending time with the founders, with their teams, and as you point out, actually seeing them kind of in the field and how they approached it, both to see the founder kind of chutzpah, but also to get a sense for what customers were thinking about the product was really important. I think, when we look back on the companies, especially those that have gone right, there was something about, Kat was a part of one, and a huge part of it at Degreed. Degreed, you couldn't look at Degreed and Dave in the early days and the founding team and not feel they were anything but pure missionaries for the cause. In other words, on the other side of the spectrum, you have kind of a mercenary approach, and you have entrepreneurs who might start to talk about, I'll tease them a little bit with like, what do you think like exit opportunities are? And if an entrepreneur is thinking already of an exit, to me, it's kind of a non-starter. Like, I think the best founders or the biggest opportunities are so mission focused early on that that there's just a driving force that continues to catalyze that for years. And that was the case with Dave. I mean, Dave in the early days couldn't raise money. He had this cardboard sign. He would show up, in front of like Ernie Duncan or some Arnie. It's Arnie. And you just saw like Dave was just fearless. He was putting it all out there, all of his reputation, everything was on the line. Sometimes there's a holding back, and it makes sense. We sort of achieve something in life, and we want to protect it and have this notion of real or metaphorical nest eggs that we build, but some entrepreneurs just put it all out there. We had one recently who leveraged a huge amount of his shares in the company, in the latest round of funding, and it was just another move that we thought was super gutsy. It showed that he was all in his business, and I think, that's what it comes down to, is feeling that this is a founder who is going to just continue to wade through the muck and mud when times are really sticky, because inevitably they will be.
Awesome. Speaking of exits, so you said that you don't like to see a founder getting an exit, but when we were talking, you
I love to see them get exits.
Or no, I meant
Yeah.
thinking about the exit too early on. You're right. But that's so funny. You had mentioned that you use the secondary markets a lot to exit a little earlier rather than ride the wave all the way through. Wondering if you could comment on that, and then Shawn, I'd really love to hear your perspective on what Sid says.
Yeah, my feeling is, as an early stage investor, so when I was building startups, there was no such thing as secondary. In other words, if you wanted dollars for your equity, it came in 2 forms. You either were acquired or you took your company public, and those created forms of liquidity for your stock in your company. In the time since, the market of secondaries has just grown tremendously. So in other words, you can, short of acquisition, short of IPO, in one of your rounds of funding, there's a chance to not only raise capital to put on your balance sheet to use for the operations of the business, but you can have capital that goes in and essentially goes into the hands of shareholders. Most oftentimes founders, early team, but also early investors like Kat and I, for example. Our feeling is if you did not, and now it's clear, I mean, the asset bubble that we all experienced, a straight decade of money being printed in our country and in the EU and throughout the world, like that just gave everybody this artificial feeling for everything we had that it was worth more than it was. You are now either a holder of an asset that just got devalued, or you sold when it was high. And we saw signs of this when you saw all the big iconic, from Elon Musk to Bezos, when they were selling, like that was some of the first indications of this is probably a good time to sell. Our feeling is if you are a seed investor and you were not selling last year, you were doing a massive disservice to your LPs. And so we were huge sellers to the tune of nearly $300 million of positions that we had on about 70 million of invested capital. And yeah, so it's critical to what we do. Part of that reason is, as an LP in some funds, I've seen seed funds that are in year like 15. Most of the time we all manage to roughly a 10-year horizon. And if you're in year 15, that's just money that's sitting out there way too long, and you're not doing your job of not only timing great investments, but in timing when to sell your position. And so we were last year a net seller. Meaning financial buyers who are coming in, leading Series C's, Series D's of our companies. We were also taking some chips off the table, and in kind of light of our LPs and their position in our funds.
Yeah, so we exist because these guys make good investments, basically. So we get asked all the time, like, well, you know, what do you guys invest in? And we for sure have, you know, certain industries that we're keen on. But at the end of the day, we say, well, whatever early stage venture funds have provided in market, that's the opportunities we're looking at. But you know, in terms of an exit, we've definitely seen a shift, I think, even from investors, that the mindset has changed for founders taking a little bit of liquidity, where I think, you know, years ago, and this was more rumors because I wasn't around years ago, but it was kind of frowned upon because it was like, why are you monetizing your equity before I do as an investor? And I think now we've seen it change dramatically, where when boards are approving it, they're allowing it. And then there are also, I think, some, you know, logistical, really good circumstantial aspects to why that happens. It's, hey, I'm in the Bay Area, or I'm in New York, and I want to buy a house, you know, that's going to cost me $1 million, and it's 1,500 square feet. I legitimately need the $1 million. So, you know, a lot of these people, and when we talk to LPs when we raised our fund, is trying to help them understand. Most of the time, when, you know, Sid's taking a little off the table, or somebody else early, this is more founder related or early employee. You know, we tell people all the time, they're not buying private jets. They're not getting that kind of money. You know, after taxes, they have enough to put a down payment on a house, maybe pay off some student loans. But really what it does, and what we feel like it provides, is them to really hunker down even more, right? They may have taken care of some personal circumstances that is real, right? They have a spouse or somebody else in their life that they say, hey, I'm worth a, you know, X amount on paper, but that doesn't, again, pay the mortgage or do anything like that. So we've seen it, you know, really mature in the last, even the time we've been investing since, you know, really recently. 2018 is when we did our first investment, and the conversations that are happening around, you know, early liquidity for employees and founders, I think has changed dramatically even in the time we've been doing it. So,
awesome. Yeah, you know, I was just thinking about the downturn with like growth stage valuations. It seems like secondary equity markets have been on a real bull rise up over the last couple of years. But with this change in valuations, do you foresee the opportunity being less than years past, or do you consider, or do you think it'll continue to grow?
Yeah, it's a good question, and we were having this discussion as a panel before. I mean, I think generally speaking, the secondary market has grown a lot because companies stay private longer, right? So if you look historically, you know, I think 2000 there was like 7,800 public companies, and in the end of 2020 there was like, you know, 4,800. So it's almost cut in half. Companies stay private longer because there's access to capital. Going public is much more difficult, and then there's an actual, you know, strategy component about not being a public company, right? It's a lot easier to have negative EBITDA when you're private, trying to take over market share, than it is when you're a public company. And so what ends up happening is more access to capital in the private markets has allowed these companies to stay private. So it has grown dramatically, and the opportunity and the education around that has grown a lot too, where, you know, all that being said, it's still a very nascent market, right? You talk to a founder, it's like when I talk to founders, a lot of times I'm one of their first times having this conversation. Like, what is a secondary? How does it work? Why do you guys do it? What is my board going to think? And so it's still a very small market in that context. But yeah, I mean, we were having conversations as a panel where, last year a lot of people were taking secondary, rightfully so, as Sid talked about. Founders taking a lot off the table, and you now own equity, and I think we'll speak to this later, but that is typically common equity. It is not the same equity that your investors hold, and so it's worth less. And so depending on the outcome of that, the company and what happens on exit, the equity you hold is at risk. And so a lot was sold last year, and I think for us, as we look at the market, we think that there'll be a dearth of opportunity as companies have raised a lot of capital. We think there'll be a lot of good buying opportunities for us. But yeah, there'll be a lot of companies that we've invested in that, our equity may be at risk depending on, again, how they perform and where it goes from here. But, again, historically, very nascent. It's growing, it's getting bigger, but still relatively underserved for the most part.
Awesome. Yeah, and, Ryan, I'm curious your opinion. So with the valuation correction, especially with growth stage firms, do you see this affecting businesses in Utah, and how do you see the trend continuing?
I'd say generally less so in Utah. I think there are a couple dynamics, I guess I would say certainly at play, and one that Sid talked about here was just pure timing. So depending on when and where you raised, the answers may be different right here. But I tend to think of more of our Utah entrepreneurs as if we think about like the heritage or the roots, they're generally sort of pioneering roots that's here. And so I think we've always had a more capital efficient, a more thriving entrepreneurial pioneering spirit inside of our companies. And so I don't think that they've created these as many binary outcomes as maybe are developed in the Bay Area. For example, not that they're just different, I guess, not that one is better or worse, they're just different. And so rather than raising $100 million on sort of no revenue, our entrepreneurs probably raised $1 million or $2 million, found some good partners, actually found customers. There's no evidence that a company is performing than when it raises from customers revenue. It's sort of this novel concept today. I still believe that this is a geography that is underfunded. I don't know if I'm unique or not around here, but the number of entrepreneurs that I meet with that aren't a fit for us, and so I sort of sit and ask myself the question, well, where will they end up? That's a compelling business, and who would or who should fund that? And again, sometimes they'll have to go back in a market like this and think about taking it from customers. There are certainly great banks out there. There are certainly sort of early stage investors, but I've sort of taken some of the pressure off, I would say, what we have to do in Utah because we haven't raised as much money. There are some companies out there that are going to have to either grow into some valuations. They're going to have to remove some employee benefits. They're going to have to cut headcount, all in a way to extend the runway and to keep growing into something. But we're not at peril, I would say, out here. Like there are awesome businesses. If you just look at in Utah, our tech job GDP growth is 3x the national average for the last 5 years. So to me, that still says that there's an opportunity here. We're still hiring. We're still sort of building companies. I think, in fact, I'll go on record. I think we're in inning like 2, maybe 3, if you could coach me into that. If you go all the way back, like our earliest ancestors are, Novell and WordPerfect, and if you look at how many businesses or investors took their stripes, their heritage from, those kinds of groups, they didn't raise a lot of money. It wasn't really available to them. Gen 2 was probably Johnny and Josh at Omniture. That's only 13 years ago that company was sold to Adobe for almost $2 billion and sort of cemented Lehigh with a beautiful building down there. So we're a decade into this, and it's going faster today. If you look at now the gap between Omniture and whether you pick Qualtrics or Health Catalyst or Pluralsight, pick any of the sort of our phenomenal companies, we're still not very far into this. So I still think we're undercapitalized. I still think that our entrepreneurs have been more rational about valuations. I think they've picked partners rather than a valuation, which makes it easier. So anyway, come back, you're still a bull.
Yeah, I love it. I love the optimism. I agree with you. just seems like there's so much opportunity in Utah that, no matter what's going on around us, we're still going to find that opportunity. I'm glad you brought up Novell. So you founded a company and raised money from Ray Norda, the famed Novell CEO, and then you moved the business to Austin. So we just talked about what's great with Utah. What lessons would you say Utah should learn from other prominent markets?
Ray's he's like our godfather, if you will, of the industry, maybe around here. And I remember after it was hard, as a student to run around, and it was a time period that, they were looking for people that, either had gray hair or no hair, and back then I had it all. And it was hard, back in the dot-com days to be able to raise money. So we ended up doing it, and it felt like to me like there were a couple of pieces that were missing in Utah and in the ecosystem here. And so I moved the company to Austin, Texas. And arguably, outside of those 3 centers that I mentioned, it's probably always been known as the 4th center, and it was always a hop. It had terrific Fortune 100 tech talent. It had awesome universities. It had maybe a better business climate. Government
Barbecue.
Awesome barbecue. Yeah. The hottest debate is which barbecue. Like that's where it has to end. But anyway, yeah. So built the business in Austin, and I would say some of the things that I learned that I hope Utah takes lessons. And if you don't tell anybody, I think that Utah has a better climate today than Austin. I absolutely do. I think Austin has not invested in infrastructure. So if you are sit outside of the downtown area, you may be stuck in a car for an hour. That will throttle, entrepreneurship and connection and innovation over a time period. I think that they, they've had a rise of costs, certainly out of there. But what they do have is they have a very pro-business government, pro-business climate, whether taxes or incentives. So I would say one of the things that I think Utah needs to do is continue to put forth our very best efforts to keep our entrepreneurs here, to both attract them and keep them, right here. And there are lots of people smarter than I will who will work on policy and certainly incentives out there. I think number 2 for me is the early access to capital. What Austin lost for a period of 4 or 5 years was consistent investment. Austin Ventures was known as the king in Austin, and they started, because of fund size creep, they started investing in cement plants. They stopped investing in the earliest stage entrepreneurs who had caused their run. So I think one of the things that I'm looking for is more angels, frankly, to get involved. We've created some interesting liquidity. Yeah, there's Landon for sure. We've created some really interesting liquidity in the last couple of years, and maybe it's been narrower in some of the companies. But I think if you really want to be a part and see what this is going forward, you got to step forward today. And it's either with time or talent or efforts or storytelling are all good things that the ecosystem can do. I think things like this. One of the things that I've always felt like Utah didn't have, and it's a little bit of what I call the coffee culture. So whether it was in Austin or Silicon Valley, it was more often that people got together for really short meetings, and you'd see each other at coffee shops. And it fostered this velocity. There was a sharing of ideas. And probably because of our culture, we're more about work and family and less about sitting and spending time with each other. And so one of my pieces I'm always plugging my CEOs, whether they're in the portfolio or out, is to talk to their CEOs. And so my plug to you all would be, go find a CEO and sit and ask some questions and talk to them, share an advice back and forth. Because I think that exchange of ideas in a really consistent fashion, when a company, sees liquidity and they have mobility and they get to go from a big company to an earlier stage company, or when CEO A talks to CEO B, I think that's one of the great unlocks for an ecosystem like this, is the exchange of successful ideas.
Love it. Love the optimism. I don't know if you guys are noticing, there's just so much optimism up on this stage today. Karey, actually, I'm wondering, you have a unique perspective because you have so many investments outside of the state of Utah. Is there anything that you would add to what Ryan said about, Utah could learn from outside markets?
We are focused on Utah. We do have a couple of investments here. We certainly don't like to miss, late stage opportunities in our backyard, but our investments are pretty evenly spread, nationally and even some international. And we obviously invest in funds as well, across the developed world. We don't do kind of emerging. I think Utah's doing great. I think, someone mentioned earlier the big companies, and you look at a place like Seattle, where you've got the Microsoft and the Amazon, and, even on the retail side, Starbucks and all these companies that have developed so many experienced leaders. And you'd think the ecosystem there would be stronger, but they don't have anything up on Utah in terms of the amount of funding coming in, the amount of companies coming, the talent. We do have a few challenges. I think I would agree with Ryan a little bit that there's less of this collaboration, and I call it the reinventing the wheel problem for some reason, and maybe it's because Utahns are very self-help. I can figure it out myself, but sometimes there's no point in figuring it out yourself. There's 100 other people that have already figured it out, and you just go to coffee with the right person and they already have the answer. And I do think sometimes, that's one thing I see in the Utah entrepreneurs is they're less willing to, ask for help from someone that's already figured it out. And so we really, we do see that sometimes here, but for the most part, I think the system here is great. Recruiting can sometimes be a little bit challenging here. I think for companies that really do need to bring in a senior person from outside, they just can't find the right talent here. Look, there's people that absolutely want to come here to ski and enjoy our outdoors. And then there's other people that are, Utah still, if you've grown up in New York, it's like, Utah, would I want to live in Utah? I mean, we still are, I'm curious for I'm not as involved with helping my companies recruit, but we do see that when they get to my stage, which is pre-IPO. And, an IPO company, one role that we really have to fill with an experienced person you do not want to learn on the job is public CFO. To take a company public, highly regulated role, we need those experienced people. We've had some great IPOs in Utah, but not that many. There's not that many experienced public CFOs sitting around. And sometimes it's a little bit hard to recruit at that level and, convince people it's a great place to live. I think those that try it, love it, but sometimes we get crossed eyes when we're trying to recruit that person.
Yeah, I was sitting in this room actually, and Mitt Romney was on stage, and Taylor Randall said, "Hey, why do you think so many businesses are moving to Utah?" And he goes, "Well, it's because the CEOs love to ski, and they want the business to be nearby." I thought it was really funny. But one thing that, Karey, also is that you get to see people make a transition from a firm builder CEO to a public CEO. I'd be really interested in hearing about that transition. And then Ryan, when we were speaking, you were talking about the growth stage being messy. If you could elaborate on what Karey says, I think that'd be really wonderful.
Well, I just hope that Ryan's already fixed them before they get to me, because we really take pride in trying to invest in companies where we already have what we call a streetable team, and streetable means Wall Street's going to like them and embrace them. But a lot of times there is a change. I thought Kat's comments were right on. This CEO that can walk through walls, believes in themselves, has the audacity to believe that they have an idea that no one else has had and they can actually execute on this and build the company. That kind of personality is exactly, what you need at the early stage. And someone that's quick on their toes. You have to pivot. The idea is not working. You can't stay wedded to that and keep, burning, Kat and Sid's money. You gotta move and you gotta change. Well, we've been in a risk on public environment for a little while, where there was a real appetite for high burn, aggressive public companies, but that's rare. And it's not anymore. So in the last 6 months, we've gone back to typical public investment mentality, which is predictability, profitability, those kind of old school things are being valued again. And it's really tough for these super dynamic CEOs to make the transition. And a lot of them just can't. But our advice to those that are trying is a lot of it's about team. People can't fundamentally change who they are. If they came up through product or marketing, they're aggressive. But getting that experienced public CFO by your side and actually listening to them, not overruling them when they're telling you that your forecast is too aggressive for a public meet and beat kind of mentality. Elon Musk aside, you have to be very, very careful what you say when you're a public CEO. Maybe he gets away with it, but most people don't. You say the wrong thing, you get censured, you go to jail. So just taking these brilliant entrepreneurs and helping mold them into someone that can live in this highly regulated public market of very conservative investors is a big challenge. So I would say well more than half of our companies, the CEO that we take public is not the founder. Unfortunately, I wish more could make the transition, but I think human nature is hard to overcome.
And you'd say that's just due to personality traits mostly. Like the
Yeah,
personality
I
not
think
to
mostly
adapt.
personality traits. And look, a lot of these people have been micromanagers. They have to be. It's their company. It's their show. Public investors don't want to be dependent on one person. If that person gets hit by the proverbial bus, they don't want to be at risk with a company that's so dependent on this one person. But I think that kind of personality is just really hard to put in a box, and it's really hard for them to step back and let the lawyers and the CFO control them enough to be successful publicly. And most of the time the board sees that well before they actually get public and helps them understand that they should move into a chairman role or some other role and let someone step in and frankly, some of them don't want anything to do with being a public CEO. I mean, some of them know they're not the person. They want to go start the next exciting thing and move on to another early stage venture company. A lot of them are smart enough to know that it's going to be kind of boring and annoying for them to be public. And so some of them step out by choice.
So why is it messy? Is that what it was?
Tell us why it's messy. Those are your exact words. I thought it was
It's
fun.
messy because metrics matter. There's 3 M's for you. I think of, oftentimes when an entrepreneur comes to pitch, Sid and Kat, let's see if I can do this so that I'll draw, like if I'm drawing, sort of a graph, and there's this sort of classic S curve, and there's this piece that sits below the line where we don't know whether it's worth something or not, but the question is being asked, is something possible? And that, sort of founder opportunity fit, the thing that they're assessing is, do I think the market is big enough? Do I think it would be accepting enough? Do I think that this founder has the raw talent or perhaps like the product insights? There's a bet that doesn't have a lot of metrics, against it. Make them up if you want, but at the end of the day, like you are making bet on people. And it's somewhat still true in the growth stage. We did an interesting quantitative and qualitative study in our team a couple of years ago, and we still found that even at the growth stage, it surprised us that the number one characteristic that determined the ultimate success of the company was still the founder. It was still the CEO, because you still at that stage can't replace the ability to attract and retain and empower talent, the depth of the strategy, the strength of the vision. But inside this really messy stage, like where growth is, I think of sort of this hockey stick of a line that's in here at some point is, how big can something be, or how fast can it go? And as such, like there's going to be a measurement against it, because it has to cross this bridge from who will fund it to will at some point will it be self-sustaining. There are certainly some public companies still today that the tolerance is lower today for burn, but they're still all about growth. That's still the question that's being asked today. So really today, understanding for a growth stage company the metrics that matter. And sometimes you're wrong early days that you thought that X would matter, and it's actually Y. And we see a lot of companies evaporate in the Series B sort of phase because they haven't proved that the customer-centric motion, like the path of sort of discernible, I guess variable customer acquisition isn't there yet. So in our stage, because our companies, just by nature of time, they sit closer to an exit than they do to an entrance, we have to start measuring companies, in that way. On our watch, they have to get to a place where we think capital is going to become a predictable accelerant, or there's a more knowable path to profitability that they can be self-sustaining. And then you've got to we're trying to understand, well, who would buy this company? And depending all about those metrics, it shapes the opportunity set for a company. Not all companies can IPO. Not all companies can sell to a financial. Not all companies can sell to a strategic. Not all companies, can cash flow forever. So it's messy, I would say, because at that point, like the metrics have to stand out more than just the market, more than just the vision. It's about doing something repeatable.
Got it. Yeah, and Kat, I couldn't help but to think of you in our conversation. So Kat helped grow a company to $1.5 billion valuation. And she had mentioned that her heart is in the early stages of a startup. I'm wondering if you can relate personally to what Karey had just said about, some people just are builders and not necessarily put in the box.
Yes, very much can relate to it. I feel it with a deep empathy in my soul. So, Degreed, one of Sid's portfolio companies, was lucky to have him in at the early days. I joined as first employee, so it was the founders and myself, and I left post Series D, over 700, almost 800 people as president and CXO. So I got to see it from pre-seed to Series D. From super scrappy, that S curve, what Ryan didn't say is that dip is called the valley of death, that you hope you can escape from, and then get to predictability and repeatability. And what is required at every single one of those stages is vastly different. What you need to survive in pre-seed and seed and Series A is very different from how you need to operate to get to scale post-Series B. And that requires you to, as a leader, as a founder, as an executive, to be flexible in how you're operating and to learn how to delegate. As you get to growth stage, the delegation is truly the core of your job. Your job is to be redundant, to have a team in place around you who can operate and tell you about the great job that they're doing. And you are just looking for different constraints to then identify and put a person in place to operate them. And I wish someone had told young Kat, as I started out at Degreed, that there would be a shift in how I would be measured as an executive, from producing to delegating and putting a team in place. And that shift happens all of a sudden and then all at once, right? And that not everyone wants to make that shift. Not everyone should make that shift, and not everyone can. And I think if we are more explicit about that shift for founders, you can identify earlier on if you're going to be the person who even wants to take that thing public, because it is a very, very different role as you get to late stage and the prep for a potential IPO than it was in the early days. And that doesn't make you any less successful as a founder or a CEO if you're not the person. And I think if we could let the ego down, more would self-select into an awareness that they're not the person, and they would spend the time building the team around them that wants to do that type of work. For myself, I wasn't. I could have done it. I was quite capable, but my heart wasn't in that work anymore. The passion that I had going to work every day, up until probably Series C, I didn't feel that same passion at the late stage. And the company deserved someone that was waking up just frothing at the mouth for that type of work. And they do exist, and they should be doing that work. Where my heart is in the early stages, when it's messy in a different way. Yeah, it's messy. You're figuring things out. You're in the trenches. That valley of death, don't let it scare you. It's a delightful time where you are pivoting and testing and trialing and failing and learning. Nothing is repeatable yet because you're just trying to see what sticks. And when you find that moment, and sorry, I'm not a BYU, I can swear, when you're just like, holy shit, this thing is repeatable, and I have put in place the motion to repeat and to scale this thing. There's very few emotions like that when you get to see that coming out of valley of death and everything's repeatable and you're on the path to scale. Can you tell I love SaaS? I just love it.
Kat, thanks so much. I really hope that some people in the audience benefit from that advice, because I do think it's profound, being self-aware and making that decision. So we've talked about founders making the transition. One thing that we haven't talked about, and I'd really love to ask Karey this question, is, you come in when businesses are established. You get to see all they brought to scale, they're efficient. What external forces do you look for as indicators of success, and what internal changes do you expect to be occurring in preparation for an IPO?
I think a lot of the words that Kat just used, things like repeatability, scalability, process, predictability, those are all those hard things that companies are putting into place to really become a machine. And a machine that's not dependent on any one person. So it's also the redundancy, like all these boring kind of terms, they're really, really important and they're really, really hard. Um, you know, sales process is probably where we see it fall apart the most, looking at the, the unit economics around their sales motion. And, early on, you might have one really brilliant salespeople. It might actually be your CEO that can just, I'll join Kit here, just sell the shit out of stuff, right? Um, and, but you can't repeat that. You've got to have a process where you can hire, young salespeople. You've got a training system. You can get them hitting quotas. You can build that machine that's repeatable. And I think that's what we're looking for at our stage. And Ryan mentioned, the metrics. He's starting to get the company from, okay, you've got a great idea, you've got some customer traction, you've got a real business, but you got to get unit economics and metrics. We're completely in that stage. The numbers have to be working. We've got to have unit economics that make sense and a clear path to profitability. Public investors, don't demand profits, but they need to understand how you're going to get there in their lifetime, which VCs aren't as focused on that sometimes, So that's what we're looking for, is just the metrics and the all the structure around the company that really allows it to scale.
That makes perfect sense. So internally, that makes a lot of sense. What about external market? Like, how do you evaluate, okay, there's still a lot of growth potential. It's, not early stage growth, but it's still going to be profound and give a good return to our LPs.
Well, I mean, clearly, we're looking for companies that we think are going to be great public companies, and public investors are looking for big markets. So there's some great early stage investments that can get a really solid exit and a fabulous return for their investors. But these days, during my early career, companies came public at $300 or $400 million valuations. That's not really a respectable IPO these days. It's really kind of $1 billion and up. And so if you're going to be valued at $1 billion or more, you've got to convince the investors there's plenty of upside. And, the public investors have a 10, 20-year horizon. So they're looking for a company that they can own and grow for a decade plus. So really the size of the markets and how, the real addressable market is critical. And there's just so many companies. I mean, one of my least favorite roles is the number of companies that I have to tell, these CEOs, it's a big gold star. They've dreamed from early on of taking their company public, and I have to tell them, your company is not a good public company. It's either too volatile, it's too unpredictable, or it just doesn't have the kind of market size that makes a great public company. And this is a better trade sale. It fits better in something else. And so many times, that's just what they need to hear. They don't like to hear it, but it's much better to hear it than go public and get orphaned publicly, which is a very, very painful life.
Yeah, that would be miserable. I can't even imagine. Does anyone have anything else to add on to that by chance? Ryan, maybe?
I thought our last comment was actually really interesting about, that not all companies are sort of public, maybe sort of received, if you will. And I think every company has a different bar. So for example, like one of our most successful investments is in a company called Stance. I hope there are at least half of you that are wearing some form of Stance today, socks, and it'll move its way from toe to head. It's an investment that we share with Kickstart as well. The difference in sort of like that, and if I thought about, let's see, another, like Lendio is another sort of business right now. I'm just thinking a couple businesses that are well known. Lendio today is probably a much more public accepted company. And it's not as much about the market size. Sort of if I thought about everyone who's wearing a pair of socks, like the market is really large. But that's a hard place for predictability. It's a hard place to think about sort of beats over time period and what can be had. Where Lendio is a a fintech marketplace, and they've moved from just providing, which is an investment we share with Album with Sid. That's a marketplace that is helping small businesses find capital. Well, they've expanded their market, and they now sit inside of bank lender tech and services. But that's something that today the market wants more of that. They understand that there is a sea change happening to the fintech ecosystem. They understand what's happening to retail banking and what consumerization of finance is. So like both of them today are well north of $100 million of revenue. But it's more likely that I would say that Stance ends up inside of Nike, Under Armour, Hanes, Lululemon, somebody who wants to extend a product portfolio, and it's changed probably how we think about building the business. It's changed how we think about what metrics need to be on course and ready and delivered at the time period of an exit. Even though we love them both the same, they'll just have different exit paths.
Makes perfect sense to me. One thing that we've kind of orchestrated up here is the funding going from seed all the way to late stage. And Karey's firm, Cross Creek, actually has what they call a private Bloomberg, where they have a portfolio of other funds that are earlier stage, and then they're able to get inside information to these firms because private companies don't publish that like the public companies do. And so, Karey, I'm just wondering if you can elaborate on some of the successes of this competitive advantage and how it's kind of led to Cross Creek's success.
Sure. I think for a lot of you, you're very familiar with, a Bloomberg or, CapIQ or FactSet. There's wonderful resources where you get very detailed financial information on public companies. And I came from the public side. I was a public portfolio manager for most of my life. And it was a real shock, how little information is really available. You can get some information online. So one thing that we do, it's a little bit different than the rest of the panelists, is we invest in other funds. In fact, we're investors in some of the funds run by the other panelists. And we're only interested in this very late stage round. We're only interested in investing in companies that we think are good IPO candidates, which is a very small percentage of the total venture companies that get funded. And so to get visibility on what everyone else is building in venture, we have a program where we invest in other venture funds, and we basically scrape all their underlying holdings into a database, which gives us good visibility. We have about 3,500 private companies that we own, unique companies that are owned by one or more of our underlying managers. And so we call that our private Bloomberg. And it just gives us, there's databases out there like PitchBook and things like that, but we just feel like the data asset we've built is far superior than anything publicly available, and really gives us the visibility to find that, gosh, it's probably 1 in 100 venture-backed companies that are ever going to kind of get to our stage. Because remember, there's all these very, very early seed companies that that are never even going to make it to the A, let alone the B, the C, the D, and a lot of my companies have raised a a G or beyond before they get to pre-IPO.
Yeah. I think that's so awesome that you guys do that. I was so impressed when you told me that. That brings me to my next question. So you get insight into a lot of different venture funds. And so, a lot of students may want to go into venture capital. And I'm wondering if you could provide them some advice on choosing a good venture fund to partner with and grow their career.
Wow, tricky one. Yeah. Look, I think it's pretty hard to get an opportunity in venture. And I think there's some great opportunities through the university and with some of some of the local firms to do internships or anything like that. To work with the university venture group or any other group. Just getting an opportunity to work in venture, I think, is really critical if you think it's a career you're interested in. It's hard to just I think upon graduation just to apply to the venture firms without some knowledge of what it is probably tricky. But if you're able to build that and you've got opportunities to join a venture firm, gosh, what would you look for? Obviously a group that's got track record, with prior investments. The one thing about venture is much less reversion to the mean than any other asset category. So the venture firms that are proven and have had great investments, the entrepreneurs seek them out. So they have a much different opportunity set. than a venture firm that hasn't done well or that's brand new. So I think finding a group that is experienced and has a reputation within the entrepreneur community is probably an important thing to look at. And frankly, in this current environment, there's been so many new venture firms raised over the last couple of years. I think a lot of them will not be able to raise again. There's just too many. And the LPs are not getting the distributions. The LPs are their investors, and the investors are not getting the liquidity now that they were. So I think they're going to reduce the number of venture funds they invest in. So if you're considering venture, I would make sure that the firm you're with, can or recently has, raised a fund, because I do see a lot of younger people get super excited about venture. They join up with some new firm and think, oh, I'm in on the ground floor, this is great. And then pretty soon that fund can't raise capital, and you're out of a job. So especially in this current environment, if you're seeking venture, I would just make sure that you're asking a lot of questions too about whether this fund has capital to invest, because it's not very fun just managing out a portfolio and not being able to make new investments. We call those zombie funds.
Yeah. Does anyone else?
Can I
Ryan?
pick up on this
Yeah,
one
please.
here for a second? I mean, listen, there's three traditional ways into the industry. Like, one, you start really young. We've got an intern here, and you can start young, and you just hopefully stick around long enough, and you're sort of there by the end. Second one is sort of the classic post MBA consultant, banker, sort of pedigreed. And the third is as an operator. There's some measure of success that you've had that you'd have a chance to teach other entrepreneurs. I would highly bias this group to go be an operator today. If I think about the advices that sort of the folks here are going to share, they come from a place of experience. And if you've never seen the inside of a business, I sort of wonder, well, what would you tell? You can see some of it in a book, but there's no substitute for experience. And again, I would say, especially like where you have the capacity, or sort of life isn't burdensome yet, go take the risk. I'd go search these portfolios and go figure out, well, where do you think sort of high measure, high interest companies are, and go be a part of their success. It will make you more attractive. You'll learn more. Like the pace of growth inside of a company is wholly different than inside of a firm. I mean, I sort of have developed ADD over time, and it's taught to me by the portfolio, because every day is a little bit different. But it means that I don't get sort of the same deep reps that I got as an entrepreneur, and I miss that. And the greatest spots where I learned were like on the trying, difficult, gritty times inside of a company. And so I would bias this group to go be an operator first, before you come back and then share lessons as an investor. That's just sort of my sense.
Yeah, Ryan, I'm not even kidding you. I was about to end on that. So the cool thing about this is everyone up here is founders in their own right. And actually, Shawn, I was hoping you'd tell your story about how you founded S20, and then after that, I'd love to hear from everyone about some words of encouragement to those looking to either go into venture capital or looking to be founders themselves and venture into entrepreneurism. So.
Sure. Yeah. So, Kat talked about the Valley of Death. There are tiers in the Valley of Death. We are not a startup in the sense, but we started the fund from scratch, which means we had no investors, we had no businesses to invest in. We had a sister business that we thought, hey, this gives us a unique advantage to go do this. And so I like to joke with my partners. It started with me. I don't think they cried the same tears, but I legitimately sat in my office, I think 6 or 7 months in, thinking, what am I doing? This is the dumbest decision I've ever made. Legitimately thought that. And so it takes a long time. I mean, Karey spoke to it. I think one of the things that I talked to Michael about is, like, we kind of felt like we didn't really need permission. There is, I would give that statement a caveat, though, in that we're doing a very specific kind of niche investment in that we're not advising these companies, we're not sitting on boards. All of these guys are doing a lot of that, and so for us, we're passive investors, and so you can kind of bucket us in a sense of how we're thinking about this as more public equity-like, and that we're making an investment. We hope we're structuring it right on the entry, and then we hope and pray like crazy they'll do what they said they will. So. But for us, it was really interesting, getting out there, and I think, looking back, being in conversations that we thought, like, oh my gosh, I can't believe we're having this meeting with this CEO, or, we had one company that was like, hey, we're talking to you and TPG and Tiger Global. We got off the phone and laughed because we're like, oh my gosh, nobody has any clue who we are. But those are the kind of conversations we were getting ourselves in. And what I told Mike is, like, we kind of realized, like, hey, you know what? Like, you can get out there, you can hustle, and if you're scrappy and you're willing to look stupid in a lot of conversations, then I think you can really get there. So we definitely, kind of like other, startup businesses, failed our way to get there. And then, kind of on point, Karey mentioned, like, hey, go ask people. Karey's team was huge for us. She has people on her team, Charles Smart specifically, that guided us through a lot of our initial investments. As we'd look at a deal, we'd reach out to them. Karey sat in meetings with us and said, all right, are we thinking about this? And actually guided us on potential investment opportunities that they were looking at that, alongside with us. And ultimately, gave us the confidence and ability to go out and actually make investments. But at the end of the day, I think the biggest thing is you got to be ready to look really stupid and really dumb, because I think that is entrepreneurship all the way through, is that you don't have every answer, and you have to understand that. But if you're willing to be scrappy and hustle, you can get farther than I think you would imagine by going through that. So for us, it ended up being a good experience. We raised our first time fund last year, and ended up raising a little over $40 million. And again, if you would have told me that when I was crying in my office, I would have laughed you in the face, like, no way, that's not going to happen. So I think it's just not really asking for permission, and go out and make it happen.
Yeah, I love that. I love that he just got up and said, I want to start a venture fund, and went and did it. So, and Sid, you gave similar advice to what Ryan, you kind of echoed him, where you told your niece, London, to go be an operator first. Kat, you were an operator. I mean, it's really compelling to see so much entrepreneurship on the stage. And when I was speaking with Ryan, he said, hey, let's not forget, entrepreneurship is all around us. I mean, when you walk into a house, someone took that risk on of building that house and then selling it for a profit. And I just think it's really encouraging to see so much optimism and upside. So I guess I'd ask the panel, each of you guys, if you could make, give some words of encouragement to the audience. I'd really love to hear it. And then we'll jump into a Q&A.
I'm trying to get Sid to go before me.
I'll go. No, I'm happy to go.
I'm like, if
Yeah.
I wait, if I make it awkward enough, will Sid jump in?
Yeah, I'll double down on operating. I mean, the difference between being an investor and an operator is like trying to run through a crowd and sniff everybody's secondhand cigarette smoke and get a buzz. Like, it's not going to happen. Like, as a VC, it doesn't compare like at all to being an operator. I remember the dark days in the house of Ryan Caldwell, who was the founder later of MX, going through personal tragedy and and wanting to just be done with my startup. I remember, moving to China with my family. I remember that day. So it was funny. My LDS bishop recommended, I was in Copenhagen, he recommended I try this berry juice. So I bought some at the store. I was drinking it. I had no idea it was 5% alcohol. I hadn't drank. So I'm drinking this drink. I get the call that my company had been acquired. Like, it was a done deal. And I just, like, after I get done, I hang it up. I burst into tears of emotion. I wasn't sure if it was the alcohol or the excitement. But that thrill of a startup, nothing can compare to it. Nothing can compare. It's the lowest of lows, but they are the highest of highs, and I just think that's why when my niece, you mentioned, she's an undergrad at BYU. She asked me, hey, Uncle Sid, I want to go into venture capital. What's your advice? And it's always the same. It's go operate. You have to operate, not just because you may find a straightforward path in and through venture capital, but you're just going to miss life and what operating from startup to a later stage company can bring, and it's just exhilarating. So I would say 100% operate.
All right, Kat, let's hear from you
I
now.
have to go. Thank you, Sid, for jumping in. My advice, I grew up on a cattle ranch. I truly had no concept of venture capital and what could be done to accelerate the growth of ideas and innovation. And I was lucky to join a company still with that naivete, but I guess a little bit of bravery, that I learned it as I went along. And the vision of that founder and the pure just belief that he had that the impossible would be possible because we were going out and we were doing the work is something that I wish I could just like glitter across everyone. That pure belief that the world needs changed and there is no better individual than you to do it. And what I love about venture capital is we make those crazy things possible, that you can dig in and you can do something that others are going to laugh at you. They're going to dismiss you, but you have a vision for what the world should be and you want to go create that. That's the type of things that we want to invest in, those innovative, seemingly crazy ideas that are going to change the world in some semblance or another, right? I guess I watched Silicon Valley last night with change the world ideas. But like that's the advice, is like, who else but you is going to do the work? And who can you bring in, and what capital could you bring in to make that possible? And by doing that, you're going to then have opportunities after. So just dig in, do the work, and know that there's things available to you to make the impossible possible.
Did he get his advice?
I think your story of S20 was his advice. So Ryan, you're up.
I was just thinking as I sat right here, I am the product of partners. If I go back and I think all through my life of where I've been the fortunate recipient of someone's investment in me, my hope is that that's something that you get to experience. Not only do we have we share the same hope or wish that an entrepreneur is full of belief. But we're also grounded in what we want to deliver. So like our limited partners are, our Intermountain Healthcare, the Larry H. Miller Family Foundation. It's the Missouri Highway Department of Transportation Highway Patrolman Fund. So the way that all these people get to go do good in their life, the way that they have a retirement, is by us doing a good job with our partnership with founders. So, if I were to say, if I had an encouragement, I would say 2 pieces today. One, go share something that you learned or you heard today with somebody else. Go be a partner to somebody. Whatever it is that you felt like you journaled, you wrote, you heard, go do that thing. My second is how much reps matter. Figure out a place where you can go get them, whether it's inside of a company. Last night I read an awesome book by Clayton Christensen called, I think it's called Competing Against Luck. And I'm an absolute advocate that you go find these great books, get the pearls out, go figure out a way to go deliver them to somebody, and then you'll be the fortunate recipient. My last piece of advice is I'd spend more time with that guy in the back who just walked in, Paul Brown.
Paul Brown, everybody.
One of the things that we talk a lot to our companies is on this route to becoming public ready, is how important independents are. And Paul was a phenomenal board member in one of our portfolio companies. And so he changed that company by sharing insights, operating rhythms, benchmarks, methodologies. That's the same thing you could go do today. You could go find somebody, like a Paul, whether it's taking a class, whether it's finding a mentor, and ask them to be a bit of your guide. Get into the things that they've done well and take them all in and go do them.
Love it. All right, Karey, you got any words of encouragement?
I think for the students, the 2 things are, really self-awareness. I think the more you can understand what a role looks like and who you are, because you think you can change, but if you're just inherently very introverted, maybe you can change, but it's not going to be very fun. And you're not going to enjoy it. I think one thing, venture, there is no Bloomberg. You have to be out there. You have to be meeting people. You have to find the deals, and they've got to like you. They've got to invite you to the deal. So if you're uncomfortable at cocktail parties, venture may be, it may put you out of your comfort zone. I think for those that want to be entrepreneurs, are you that risk taker? Are you willing to walk through walls? It's going to be hard. There's going to be that valley of death and tears. And just, understanding where you feel most comfortable. And then I think the other one is ask for help. People actually do want to help. And I think so many times I see people struggling so hard with something that lots of people around them, already know the answer, or could just give them a boost up, could make an intro, especially for students. Sometimes it's really scary to reach out on LinkedIn or something to someone that's further in their career. And sometimes you won't get a response because people are busy, they just don't get back to it. But if you can get connected, people really do want to help. And I think it can just save you just so much time. Just the right advice from someone experienced can save you years or big expensive mistakes.
That's awesome. Yeah, and just as an example of the generosity and people wanting to help, each of these panelists are incredibly accomplished, as you can tell, and they took time out of their day to be here. So let's give them a round of applause. then we'll turn the time over to Riley and do a Q&A session.
All right, we just have a few minutes for questions. Who has a question? Please raise your hands. I saw you over here first. If you don't mind telling us your name.
Hi, I'm Usman Sattar. I'm a second-year PhD student at the Department of Biomedical Informatics. My interest is in digital health. So my question is for two of the earliest stage VCs over there, Kat and Sid. Do you invest in digital health? I saw a couple of your companies in the portfolio. And what's your average check size, especially for the seed round?
Yeah, we steer clear of like life sciences when there's a long gestation and a long period of investment and things like FDA approval. It's just we're not built for it because of our check size. So we write $1.5 million to $3 million check. Probably the smallest check's $1 million bucks. And we have had some success in healthcare tech companies.
Ditto to the type, as Sid said. Check size for us, anywhere from 250,000 upwards of 3 million, just depending.
Question. Oh, we have a question over here. Again, say your name before you ask your question.
Hi, I'm Gonzalo Peña with Inno Latino podcast. I've had the privilege of interviewing Sid for my podcast as well, and because of that, I know that getting in touch with his own Latino culture helped kickstart the entrepreneurial spirit in him. So I guess my question is, Latinos are the largest ethnic group after white in Utah, but in BC and startup world, there isn't a whole lot of diversity. Is there anything that the VC world can do to improve these numbers? Thank you.
Yeah, I mean, we strive to be the best VC anywhere in the world, and it just so happens that we are majority Latino owned. You know, my partner Diogo is from Brazil. As you mentioned, I'm Chicano, I'm Mexican American, and I think the first thing that's important is just the same could be said for women or any group that hasn't been represented in our industry is you cannot be what you do not see. And so on one hand, you can see it. Like we are at a time in the state, especially beyond the Latino community, where there are women now, in venture capital like never before. Karey's a pioneer in it. Kat and others, friends of ours are in the industry, and so I think there are steps being taken. What we've done, just speaking for our firm, is we focus our interns on groups, specifically Latino and women, in local universities that we want to kind of bring in and give them exposure. We find that oftentimes it's just they're not seeing people that look like them, and they just don't have exposure to realize like this is not rocket science. Like there is, like any craft, there is learning that craft, and reps are everything. And having time in a board meeting type setting where you can get exposure to these things starts to dispel the myth that this isn't for you. It may not be for you. To Karey's point, everybody needs to kind of find where their strengths lie, but we absolutely need more Latinos in our industry.
Maybe I could just add one thing there. Because we invest in funds, we see a lot of these new funds, and we are seeing in the last few years so many more diverse GPs of all kinds. And so unfortunately, a lot of them, don't have any track record. They're struggling to raise capital, but there's a lot more of them out there. And we are seeing some limited partners with very aggressive programs dedicated to funding, these GPs, even if they don't have the track record that they would normally require. So we're seeing some real progress, but it's a very it's mostly very small, funds, but we're seeing a lot more of them than when we did. So hopefully a positive sign.
Yeah, and just to add on to this, we specifically wanted some diversity up here on the stage, and that was because the U is promoting this diversity in thought leads to better outcomes, and that's just fact. I mean, there's no real debate in that. And I do think that anyone in the audience, if you have an event coming up, it's really important just to make sure that all walks of life are included.
Perfect. Thank you so much. We have a question from our live stream audience. This is from Matt McBride, who asks, that was an interesting comment from Karey about firms having the ability or not to raise money from LPs? How would an entrepreneur know when talking to someone?
Well, I'm not sure if it's an entrepreneur, they're probably looking to raise money from VCs, and that's a little bit different than raising capital for a fund. It's a strange environment. It seems like, 9 months ago, you could raise money pretty much for anything at a pretty ridiculous price. I mean, the market was so frothy, and things have turned on a dime. We're seeing in the later stage in our companies that people just aren't trying to raise, so it's hard to know if they could or at what price. Most of them raised money in the last 12 months. They don't need to raise capital. They're reducing their spend and they're extending their runway so they don't have to go test the market. The IPO markets are basically closed. I mean, obviously something like Porsche gets public in a hot IPO, but that's not your sort of venture-backed profile. But maybe a better question on the companies and can they raise, for some of the earlier stage investors. I think it's a time of uncertainty. The LPs and whether these funds can raise money, whether it's a small new diverse manager or even a more proven venture fund and whether they can raise capital, I think it's going to be tough, and I think it's very hard to know. One of the big challenges is as interest rates rise, big institutional investors can at least make some return on their cash with taking no risk. And the percentage allocation to equity and private alternative investments for big institutional pension funds has grown very dramatically over the last decade because they were just making 0% on their risk-free allocations. As that rate starts to rise, we're seeing them shift back, and that means they're cutting their venture and private equity and alternative investments. And they're also getting less cash back from, some of the funds because companies aren't going public right now. There's not as much M&A and liquidity. So I think it's, certainly a lot of funds are going to get raised, but it's getting harder. But for the early companies, maybe better for one of the other panelists.
We have another question over here.
Hi, I'm Paul Hewish, local entrepreneur. I'll just offer this up. Mike, you can dish it out to whoever wants. What was your first job in high school? And what did you learn from that has impacted your professional career?
I'll give mine really quick. My first job was a paper route. My brother had a big paper route, and he had to walk me home from school. So I think at about 9 or 10, I had my one little street with 10 houses, and while he would do his 60 houses on his bike, I would do my few houses. And the scariest thing ever, which is along this line of moving from public investing, which is mostly sitting behind a Bloomberg, out to sourcing deals for venture, was hard for me. The scariest part of the job was knocking on the doors to collect my $2 a month for, you had to knock on the door and collect the money in person. That was very terrifying.
I was a paper route, as well. My dad is an entrepreneur and he's 70 today and is still at it and has been inside medical tech. So that's probably where I draw a lot of my wishes or wants as to what made a business successful or not. But sort of early on in high school, I probably always had 2 side hustles. I grew up in the Northwest, and so Land would notice I was power washing driveways, sort of getting rid of moss and things like that at the same time as sort of 3 or 4 other gigs. So learned entrepreneurship.
I also started with a paper route, but I'll share when I was at the U.
Go paper routes.
I was a waiter at Sizzler while I walked onto the team here. I played ball here, and in order to make enough money, because I was a walk-on athlete, I didn't have a scholarship, I would trade my shifts at the Sizzler and Sugar House. It's so sad that that's going away. I would trade my tickets, player tickets to games for the best shifts, Friday and Saturday nights. And I learned customer service, just treating people, well, with a smile and working for that tip.
I was a ranch hand. But truly, I grew up 3 sisters, myself, and 1 brother, and we have almost 4,000 acres to operate. It's a very big operation, and my dad just put us to work. And the thing that I learned there was you can figure out a way to do anything. And I was lucky because my dad put me in situations, from a very young age, he was watching more closely than I thought he was, but he would just put us in situations and say, figure it out. And so I learned how to problem solve, how to get creative in problem solving, and also when to ask for help when I actually couldn't figure it out on my own. And I'm very grateful for my dad putting me in those situations so that I could build those muscles from a very young age.
I'll do one a little later in life. I mowed lawns when I was younger, but then did bank teller. I think something I learned there was stay in the drive-through. That's all the easy transactions are in the drive-through. The annoying, difficult ones are actually inside the branch. So I stayed focused on the drive-through and realized it was a lot more efficient for me. And then you basically have the same people come through the drive-through. So from a customer service perspective, I knew some people wanted their money outside the envelope, some in, and you got to where people like me. I was actually offered 2 jobs at a drive-through teller, which I thought was kind of funny. So that worked out.
Perfect place to end. Unfortunately, we are out of time. I will say I was a bank teller as well. Drive up over in Foothill, so I know exactly what you mean. Let's give another round of applause for our amazing panel. All right. We are so appreciative of each of you for participating today. As many of you know, the David Eccles School of Business recently ranked 5th in entrepreneurship for undergraduates. That's in the entire nation, 5th. That's incredible. The only schools ranking above us are Babson, MIT, Berkeley, and Wharton. I have personally invited Paul Brown of our Masters of Business Creation program to share just a brief thought with us today. Paul.
Hey, everybody. It's great to be with you, and it's so wonderful to have these friends of the school. We so appreciate your time, and Mike, you put a great program together. I want to urge you and people you know to apply to our Masters of Business Creation program. It's, I think, unfortunately, a better kept secret than it should be. We've had 67 companies come through this program. You have to have a startup in order to be admitted. It's a highly practical program, so you immediately integrate what you learn into your startup. We've had outcomes from nonprofits that have grown and built their mission to software companies that are worth $500 million and everything in between. Unlike a lot of startup accelerators, we don't have a dream for you. You don't have to be venture backed. You can bootstrap, you can operate it as a lifestyle business, or you can raise money, and we've had a lot of companies raise millions and millions of dollars. Mike and Andrew are successful graduates from our program. They're terrific. And if you go to MBC Utah, you can find how to apply. If you know anyone who has a startup, or if you have a startup, imagine being surrounded with tons of one-on-one mentoring, a $5 million venture fund, grants, loan opportunities with banks that have partnered with us, and tons of connections. And so we'd love to have you or your friends apply. It's really a remarkable program. It's getting a lot of attention. And thank you so much, everyone, for coming, and hope you'll check out MBC.
Thanks, Paul.
Thank you so much, Paul. I will put another plug in for MBC. Harvard created the MBA. The University of Utah created the MBC. This is where you want to be. So how incredible is that? Thank you, Paul.
And I just want to jump in, since I'm a graduate of the MBC program, real quick. Taylor Randall was up at an event 2 weeks ago in Eden, Utah. I know Sid and Kat were there. But he was talking about how the MBA changed business, and he foresees entrepreneurs, academia, fostering entrepreneurs being the next major change. And that was the motivation for creating the MBC. And I can personally attest that it is a wonderful program. And lastly, let's all give a round of applause to Riley for being our host and the rest of this Utah team.
Thank you so much, Mike. Again, we do have box lunches available for pickup. Just 2 quick things I want to direct your attention to. First, on Friday, October 21st, we have our Evergreen Symposium. If you're wanting to know more about the private side of business, please come to that. We have flyers with more information and how to RSVP. In addition, on October 18th and 19th, we have our 1917 Giving Day Challenge. Your support can unlock challenge grants, which will provide greater funding for student scholarships. You are able to donate now to the 1917 Challenge by scanning the QR code on the screen. Please consider donating today. And lastly, I would like to thank our David Eccles Alumni Network Board, in particular our Alumni Outreach Committee, many members of which are here today. Thank you for providing so much support to the Eccles Alumni Forum. And again, thank you all for attending. As always, go Utes.